Hi, everyone. It's Danielle Turkovich. I am the head of brand marketing here at Lazier. You all have probably received emails from me, invitations to join this very event. So I thought that I would hop on and welcome you all here for our 2024 established ESOP first ever event in 2024. You'll notice some new faces on the screen today. And so I thought I would take a second just to introduce those folks. I'll start with Josh Seidman and I'll let him introduce everybody else. Josh is a managing director here at Lazier Capital. He's been with the firm for 5 years and in the industry for over 15. He was a senior manager at KPMG, leading some really large transactions there. So he has an impressive professional background. And on top of that, he is working day in and day out with our clients. And when he's not doing all of that, he's a father of 2 adorable kids and a husband and a dog dad and a New Albany resident. So he's many, many things to many people. And we are so glad that he's here. Before I hand the mic to Josh, I just wanted to remind everyone that in the webinar format here on Zoom, that your camera is not on by default and your microphone isn't either, but we really want to hear questions or thoughts that you're having as we have our conversation today. So you don't have to wait until the end. You can pop that into the Q&A function at the bottom of your screen. You can, write us a comment there or in the chat, and we will see it. I'll be behind the scenes making sure that the panelists can see your questions as well. So without further ado, I'll hand the mic to Managing Director Josh to take us into the next phase. Okay, Josh, take it away.
Thanks, Danny. I'm gonna have you come home and give that spiel to my wife. That was it's really great to be here. Very excited about moderating this group of professionals that you're going to see throughout the year, with new folks coming in and coming out. And really, I think, as you all know, the forum here is to create topics and points of conversation that are engaging for mature ESOPs and really any ESOP after the closing has occurred. And so a number of different events, and really trying to keep this palatable and enticing for folks, whether you are 2 months from the sale of an ESOP or 10 years removed from the sale of an ESOP. The ESOP has a life cycle, and have this great group of professionals here to help us tackle all the issues that come along. So before I introduce them, the first issue, an item that we're going to tackle today, is just thinking about the earlier years of an ESOP. Years 0 to 3 or 4. 5, what do we need to be thinking about? What do we need to be taking into consideration, and knowing all the right players and the right parties? So very excited about that. To help with the forum today, really excited to introduce a couple sets of professionals that you may have seen before. We have John Purdell from Principal Financial. We have Jeff Jamarino from Lazier Capital, serving as a post-close advisor, and Kirsty Corey, a trustee with SCJ Consulting, lots of years on the trustee side. So very happy to have this group of professionals and their broad breadth of experience on the topic, because it is a kind of wide open topic for consideration. We will tease this at the end, but we'll introduce what the next topic or two are going to look like. That'll kind of play on to, from today's theme. We'll take it a bit deeper dive in the next forum. So without further ado, I'd like to jump right in. And as Danny mentioned, if you have questions, please send them through to the chat. Danny or I will get to them, and we'll lead the moderation, but please feel free to jump in. We want to get your questions answered. So without further ado, I really thought I'd start with John here to kind of kick things off. So, John, we've sold the company. We're now working in an ESOP-owned company. Maybe it's been 2 months, maybe it's been 2 years. Lay the groundwork for us on what some key considerations or key themes that we might want to make sure that we're thinking about, and we can let the conversation go from there.
Sounds good, Josh. Thanks. I think whenever I think of what's the most common thing that I see right out of the gate from these companies after these transactions, you get to that first year end, and companies are seeing that, sure, the stock price is depleted because of all the debt, and the allocation isn't necessarily meaningful to employees, right? Because the share price is so low, we're still releasing shares. It's just that the value isn't there because of the depressed stock price. So they have a tendency to want to release more stock because to kind of make up for that share price fall, if you will. And I see that many times in both an S corp and a C corp situation. And what is, I mean, it's certainly admirable to think of that in terms of from the company's perspective, wanting to deliver more to the employees. But whenever you're in that position, don't be teased by just trying to increase that benefit level by releasing more shares in year 1 or 2 or 3 to get to a targeted benefit level or a sort of, some higher benefit level. Because once those shares are allocated, we can never unallocate them. So they're in the buckets of the participants. And as you all will see, as time goes on, that share price will come back. It'll come back aggressively. And now, 5-10 years in, you will see balance that are very significant. And you may even wish that we would not have front-loaded balances in the early years, because now we have to buy those shares back from the employees that leave or retire. So it's not to say that you shouldn't do it. I'm just saying that maybe take a closer look. It's not as easy as it seems. Don't just look at the initial impact positive to the employees, but look at the long-term negative impact to the company's future cash flows of added shares being allocated and having to be bought back down the road. And it's a forever increased buyback, because like I said, those shares are always going to be allocated, and they're always going to be in someone's account that you're going to have to buy back when someone leaves. So that's point number 1. And I would say point number 2, I see it just in the C corp post-transaction situation. And that's where the C corp is maybe a C corp for a period of time post-transaction, waiting to switch back to S corp possibly. And so what is a C corp concerned with in those early years? Deductions, right? And so sometimes companies will want to maximize their deductions in those early years right after the transaction. And so they make a larger contribution, get a larger deduction. But what does that really result in? The same thing that we just talked about, more shares being allocated in those early years. And so, do some analysis to look at what is I'll say the benefit cash wise and from a lower taxable income base versus the future negative impact on cash flow from having to buy back more shares that we allocated because of the increased deductions in these early years. So it's just take that discussion a little bit further and think from that perspective as well. I know your accountants, and that's their job is to give you more tax deductions and increase tax deductions to get to a lower taxable income. And that's their job, but just pay attention to the negative impact long term, and just make sure you understand that when you're making those decisions.
Kirsty, from the trustee side, would love your perspective. What are you focused on kind of advising clients about when they're going through these types of analyses?
Yeah, Josh, so I would say right out of the gate, obviously, John, he's spot on with respect to some of the plan, the front loading, et cetera, that you need to think about. But what we hear a lot from our clients, we usually try to do these day 2 calls because they want to understand what's going to happen next. So number 1, we try to kind of lay out the timeline of, the life, the year in the life of an ESOP. So what do they have to kind of meet next? I think communication to participants is particularly important. On average, they say it takes about 4 years for a participant statement to really be meaningful to a participant. So I think communication in the early years is really important to help them understand the ESOP, understand that it may look small in the beginning, but it definitely can grow over time. And again, to John's point, when you kind of front load the ESOP, yeah, that can make their balances or their benefit level look larger, but that could have a negative impact in the future. So most of our plans, they look tiny to a participant in the beginning, but they have a tremendous ability to be very meaningful as time passes. So I think communication is one of the most important things for a new ESOP. A couple other things come to mind, maybe unrelated, but kind of related to what we'll get into later in this presentation. Understand new ESOPs, what your SPA, so the stock purchase agreement that was signed at the time of the transaction, really understand what obligations that has in there in terms of is there a certain contribution level that has to be met or benefit level that was promised? Is there an obligation to get a repurchase obligation or sustainability study within the early years of the ESOP? That's become very common in these ESOP transactions and something that gets built into these agreements in most transactions that I'm seeing. And then kind of the other point is your corporate governance or board meetings. A lot of the companies that I work with haven't historically had formal board meetings, and this is where some formality, when you add an ESOP to your capital structure comes into play, is you really want to make sure that you're having board meetings. It may be a new thing for some companies. I'm going to say roughly 80% of the companies I do transactions for don't have formal board meetings. And then one of the topics, well, a lot of times we'll help our clients kind of outline that agenda or what it should look like. And then it kind of morphs into what works best for the client. But one of the items that is typically on the agenda at a board meeting is ESOP repurchase obligation and sustainability. And again, as John indicated, what do you want your contributions, to look like? What do you want the funding piece of the ESOP to look like? And how is that impacting the repurchase obligation? So that typically becomes a topic for our ESOP companies and their boards.
I love it. And really great transition to Jeff. Maybe, from a company side, Jeff, who does this, right? Who is responsible for thinking about this and being educated about the ESOP from a company's perspective? Do I have to have a committee in charge of it? Is it senior management? What do you typically see, Jeff, given your experience with kind of who takes ownership for kind of tackling some of these?
Yeah, great question, Josh, and thank you for that. So typically, often in most plan documents that I see, written right into the plan document, there is a specific item that says that there will be an ESOP plan administrator, and that ultimately that's something that a board of directors should take action on and make sure that they name an ESOP plan administrator. Now, that can be a person. The board can take that role on themselves if they choose to, although I don't think that's probably the best solution. Or a committee can be created to handle that sort of responsibility. And so I've seen it all over the place, but I would say in early ESOPs, I typically see where an individual within the company is typically named to be that administrator. As an ESOP matures, that's when I tend to see movement toward creation of an ESOP administrative committee to manage those responsibilities.
Very insightful, because I think, as most of us know, and a lot of our clients are learning, is that ESOP plan document and the actions, that one might take, it's a living, breathing document, right? And I think a lot of folks, maybe think that you set the ESOP up and it runs the way that it runs and it does what it's supposed to do, but there really is a life cycle and some thought that committee or the board should be putting in, whether it's thinking about diversification down the road, whether it's thinking about setting up a distribution policy and looking at that annually. John or Kirsty, would love for maybe you to kind of, chime in on your thoughts about, what you see best practice wise from those committees, how often they are are looking, and even Jeff, your perspective, how often
Mhm.
should one be thinking about the distribution policy and be thinking about, hey, what are we going to fund this year and how are we going to fund it? Is this something we do every year?
Yes, so for I'm sorry, I'll jump in real quickly. There are a lot of different responsibilities of that plan administrator, whether it's a committee or an individual, including things like repurchase obligation and the repayment of the debt service between the trust and the company, and making sure statements are distributed and all sorts of other things. But I found that typically once or twice a year, more than once a year, probably twice a year was pretty typical for a group to get together if it was a committee and review these things. Once typically in the spring, maybe after the valuation had been completed, and once towards the end of the year. And a lot of those issues can be addressed at those times. But we would meet at other times depending on need. There wasn't a formal, oh, we can't meet now because today's not the day we designated. You had to be flexible too.
Yeah, and I can jump in here too. I mean, there are different types of ESOP committees, some that have fiduciary responsibility and some that don't. So you might have like your ESOP communication committee, that they're just communicating the ESOP and coming up with ideas to share with the other employee owners. And so they typically don't have fiduciary liability. And then with the committees that are oftentimes defined in that plan document, it's exactly what Jeff said. A lot of times it is just an individual, but sometimes you have a committee of the board that's kind of responsible for making those decisions. Other times it is a committee within the company that is formed for purposes of handling things like repurchase obligation, et cetera. And so Jeff would probably know better than me because he's been on the company side. But my experience has been those committees meet when needed, and we're getting directives from them as to how to carry out what they have determined in terms of funding of the plan or meeting repurchase obligation, et cetera.
Yeah, Kirsty, you're exactly right, and as I said before, it's kind of on an as-needed basis. Usually, we would schedule one or two a year just to make sure that we did do it. A couple other things that maybe you don't think about right away, but our within the company I was at, our ESOP administrative committee ultimately became a nominating committee for our board of directors. And that was a duty and responsibility that they took over once our sellers had left the company and were no longer involved. And management of the plan document is another really important one, where we found that, and I know we're going to probably talk a little bit more about this, but as our document changed in that, it needed to be managed, and there needed to be coordination with our ESOP attorney to make sure that that was being done properly.
That's actually a great transition, Jeff. John, what are some reasons why we might want to be looking at that plan document the first couple years post-close? What do you typically see as maybe some tweaks or changes or amendments that get made kind of in that first 5 years down the line? Maybe some examples might spawn questions or insight.
Yeah, I think it is first and foremost, just know that there was a lot of time and effort put in place during the implementation phase and design phase, but also know that we're not going to get everything exactly perfect every single time. So it is meant to be a living document, and it can be changed as you go down this path of an ESOP. And oftentimes they are changed, and sometimes they're changed the very first year. Sometimes it's a couple years. Some of the things that I see being changed with the documents are, first of all, some companies may start out with a unique formula for allocating the shares, like a points-based formula to kind of get more shares allocated to maybe their longer term employees, because they're just not going to be around long enough with the ESOP to accumulate the benefits that maybe younger employees would. So that's a somewhat common plan design, but it's not meant to be a forever plan design. It's just meant to be, maybe it's for the first year, first couple of years. And so that's certainly, if you have that type of design or allocation formula, you're going to want to take a look at that and maybe change it to a compensation based formula, a couple of years in, if not the second year. So that's one thing. And another would be, like I said, we might have guessed wrong on how eligibility should be determined. We've seen a trend lately, the last, I'd say, 4 or 5 years, as companies compete for talent to open up the ESOP and allow people to get into the ESOP sooner versus later. That was never the trend in my 25 plus years in this industry, but it is a trend today, getting people into the ESOP sooner. So if your provisions are maybe making people wait a year or more to get into the plan before they actually participate and get their first statement, and you're seeing that maybe that doesn't necessarily fit as well as you thought it might. So, take a look at maybe accelerating those eligibility provisions. Those would be my two main ones.
And John, from my perspective, right, being inside of that ESOP on day one, I know what I found, and I was the guy that sat there with an ESOP attorney and went through the plan document and said, yes, do this, yes, do that. Honestly, I didn't understand what I was agreeing to half the time, or at least I didn't understand the implications of what I was agreeing to. And it took a year or two before I, after we had implemented the ESOP, to all of a sudden go, that's not really what I wanted to do, or that's not have that ability. Honestly, at first, we didn't even know that we could go and amend our plan document, until we had some further discussions with some of our professionals to realize that, yes, this can be changed. Yes, you can go back and make adjustments to some of these things that you decided on before you were ever involved in an ESOP in the first place.
So that's one of the biggest things I hear from clients, is that even a couple months into a new ESOP, they're like, I really didn't know what I was doing when I filled out that checklist. And I've had a couple where it's like 2 months in, they're like, that's not really what I meant. And so there are some things that are harder to change than others. And so what I try to, impress upon, the sellers, the plan sponsors, et cetera, is like, just go with the statutory, terms, and then we can get more lenient if you want. But I think it's everything is a flurry of activity leading up to that transaction. And that's, Jeff, that's so spot on and common from what I hear.
And one other situation I want to point out as well is, as we went along and we became a little bit more mature ESOP and we started to have more cash available after some of our debt service was paid down and that sort of thing, is we started making some acquisitions. And there were situations, depending on the employees of the other company in that, where we needed to make adjustments to our plan in order to accommodate these new employees that were coming on board. So knowing that you can make policies that will affect this new acquisition that you're making, you need to be aware of that as well. And a lot of it tends to center around, do we want to give people things like give them credit for prior service as it relates to their vesting period and things like that can have an impact on how well you are received culturally by the company you're acquiring.
Awesome. Great comments. And maybe kind of a dovetail would be this idea. I'd like to maybe move towards talking about a distribution policy. And then I wanted to get into a few other things. I know a lot of times when I'm working with clients and we're establishing the ESOP at the forefront, the distribution policy is not always top of mind, and candidly, not even something we typically put in place at the closing because you have some time to nurture and mature and then think about kind of what that committee is doing and what a distribution policy is and how we're going to use it to our advantage from a company and employee perspective. John, maybe I could start with you. What is a distribution policy? And then maybe we can dovetail and hear from the others on, best practices and timing of how to put that in place. Because I think it can serve a lot of strategic advantages for the committee to think about benefit level, cash flow protection. It's a good kind of balancing act. So maybe you can get us started on that.
Yeah, and I think Kirsty said it well, and that most of the time, especially distribution provisions, are drafted into the formal plan document with the outer limits, kind of the maximum delay that you can put in place to pay people out. And that's by design so that we can protect the cash flow of the company and use the cash flow to pay off the sellers, pay off the bank, before we are paying off former employees with an ESOP balance. You know, that's just the standard. However, as I mentioned earlier, the stock price is low in the early years, and the benefits are vested balances are low, whether you granted prior service or not. And we are only going to see those balances grow over time. And if we are not paying those balances out to those terminated folks, then those balances are going to increase. And so we're going to get to a point where, yeah, we were saving cash flow to pay off the bank and the seller notes and whatever, but at the same time, our current repurchase obligation for our terminated folks under the ESOP, their balance has continued to grow. And so you get to a point in time where, you know, maybe we should reserve some dollars, set some cash aside to handle this repurchase obligation at today's price versus seeing it continue to grow, and having it just be a bigger bite that we have to take down the road. So I'm not sure that there's a given time frame like year 2 or year 5 or somewhere in between, but I'd say it's more a facts and circumstances. Is the company comfortable with its cash flow and comfortable that we're satisfying all the obligations that we have outside the ESOP, and that maybe we can start kind of tackling that ESOP obligation a little sooner than what we initially designed as the outer limits. And it's really to save the company some cash. And also from an administrative perspective too, we all know that it's hard to keep tabs on employees or former employees the longer you get from when they were an employee, right? So, you know, keeping track of them and locating them 5 years after they've left is sometimes a challenge. So it's both from a cash flow standpoint, paying out balances, the smaller balances at today's price versus waiting until they get to be more significant balances, but also just the administrative aspect of it.
And John, you brought up a couple of points I want to just touch on real quickly. One of them is you talked about those outer limits in the plan document, and those I just want to point out to everybody, those are typically governed by ERISA, right? And those are not something that we're deciding as professionals, but the government is telling us what those limits can be or have to be. So I just wanted to point that out. Secondly, and your point is excellent about cash flow, and that our experience was that we did an analysis, and given the fact that we had borrowing power on that, even if we had to go and borrow money, looking at the growth rate of our share price in that and knowing what we had in front of us, it would have been cheaper for us to go and borrow money to pay those people in year 1 after their retirement or termination than it was to allow that share price to continue to creep up. And there's also a cultural aspect to that too. And I think this is really important. Do you want to tell your employees that, hey, we're going to continue to reward people with increased share price, even if they're not here contributing to the effort that it takes to cause that share price to go up? And I think that's important too.
Great comment. Kirsty, any input from what you typically see as you're seeing companies put those distribution policies together for the first time, or even making, tweaks?
Yeah, no, I think it's very important. Again, going back to at the time of the transaction, you're picking these provisions that, you're not really sure how they're going to affect the plan. I try my hardest to get everyone just to take the statutory, the most lenient provisions possible, and then going forward, once you kind of get to know your plan, you can put in a distribution policy to be more lenient than maybe what the statutory requirements are, because once you put something into place in the plan document, it's very hard or difficult to kind of go back on that. Maybe in some cases impossible. But the distribution policies become, very important and can tie right into repurchase obligation sustainability study, which will give you a lot of answers as to, is it cheaper to cash people out now, which I will tell you in all the sustainability studies that I see, the answer is typically yes. The sooner you can pay people out, it does become more cost efficient for the company. However, you want to understand how those shares are going back into the plan. And the distribution policy can address that. Will you redeem the shares and retire them to Treasury? Will you recirculate them in the plan? And so that's kind of the other end of the equation is, yeah, it's great to cash people out sooner rather than later. It's less costly, but then how are those shares either getting reallocated or not? That becomes, another part of the equation that a sustainability study can help you answer.
Maybe a great lead in, Kirsty. So I thank you for that. Let's talk about a repurchase obligation study and a sustainability study. I know when I'm working with clients and sellers and negotiating that ESOP transaction, we don't have either of those, right off the bat, but we negotiate that, the bank wants it if we're getting senior debt, and certainly the buy side wants it. And obviously a smart CFO would know that they would want it as well. But we commit to doing a repurchase obligation study, 2-3 years post-close. John, maybe I could turn it back to you to kind of kick this off. Compare and contrast for us. What is a repurchase obligation study versus, as Kirsty was talking about, a sustainability study? I know sometimes people might think that those are synonymous terms, but I think they actually kind of tell different sides of the story, so to speak. Give us the high level on what those two are, and we can work together to break it down.
Yeah, and I think it is worth clarity, right? Sometimes they're used interchangeably. I don't think that they should. I would label it such that a repurchase liability study is a subset or an input into a sustainability study. But it's not, the reverse is not true. So a repurchase liability study is really just looking at kind of one-dimensional, looking at your forecasted ESOP repurchase obligation from terminated participants, whether that's, due to death, disability, retirement, turnover, and taking into account a share price forecast that you're looking at and quantifying what the cash flow need might be at some point in the future. And that's it. It's really designed to do that and that only. And it's still valuable for, like you said, Josh, for the bank to know what that looks like, for your trustee to know, and for your CFO to know, and the board to know, just to not be surprised, and so that you can plan for this as much as possible. So first step, always do a repurchase liability study, as Josh mentioned, per your agreement, if not sooner, or if not more often. I think it is very valuable to have eyes on that. And what I see as a sustainability study is really taking that repurchase obligation analysis to the next level. So it's incorporating the output from the obligation study into a more robust financial modeling that takes into account all aspects of the company's cash flow needs. The ESOP obligation being one of the draws on future cash flows, but obviously the company has other cash flow draws. And so it's building a model and analyzing it into the future, accounting for what is the ESOP's impact on those future cash models, if you will. So really building that future repurchase obligation number into my financial forecast and making sure that the company is going to have the cash flow based on its projections to satisfy that liability and to satisfy the other needs for cash that the company has. And therefore you get the name sustainability. Can we sustain this ESOP into the future? So that's how I would take it. The second thing I would say is, when you are doing the repurchase obligation as a step into this sustainability study or an input into it, we are working with the valuation firm very closely. And so when we're talking about the important input into an obligation study, that being the share price forecast, we are getting that share price forecast from the valuation firm who has built this sophisticated model of future cash flows in integrating the repurchase obligation number into it. And so we are not just taking a flat line 5% growth and putting it into our model and letting it run out. We are starting there, but then we feed that information to the valuation firm. The valuation firm puts it into their model. They shoot us back an updated set of share price forecasts, so that we are fine tuning what that obligation looks like based on all the other financial projections of the company. So it is definitely kind of version 2.0 of an obligation study when you build it in with that valuation firm input in their model.
Kirsty, I mean, best practices that you've seen from the trustee side. I'm sure you've seen a lot of sustainability in RO reports. You know, best practices, or what do you see tends to work well?
Yeah, so great question. So a lot of my companies, they might go get a repurchase obligation study, the ones that I work with, and just give it to me and say, oh, what should we do? And what I typically, the box I'm put in is, well, as a board, the board doesn't have enough information to really make a decision, because as John mentioned, boards can't just think about the ESOP. I mean, even though I, as a trustee, am thinking just about the ESOP, but there are other, um, considerations that I have as well. We want to make sure the management team is happy, and a lot of times they've got a SAR plan or something of that nature, and that's where boards really have to think about all of the stakeholders of a company. And so what a sustainability study will do, it's exactly what John said. They're going to give you a more broad picture into the liquidity needs of the company, how each stakeholder is affected, and how decisions that you make within the ESOP, i.e., do we reallocate the shares immediately? Do we cash people out sooner rather than later? What are the distribution thresholds? How do those decisions affect the other stakeholders, warrant holders, SAR holders, it's liquidity needs of the company? So in my opinion, boards that are dealing with ESOPs that, maybe you have a have or have not problem, meaning that, I've seen ESOPs where 90% of the value is concentrated in, 10% of the employee account balances. How do you kind of solve those problems without having a negative consequence on the other stakeholders of the business, or a negative impact to the valuation, which ultimately comes back to affect the ESOP participants negatively? So the sustainability study kind of helps a board look at every different perspective and work their way to hopefully a solution, because there are so many different levers you can pull, both on the company side, on the ESOP side, that could really make a positive difference.
Jeff, any comment from you on the company side? You know, if you had
Yes.
these studies done as part of your course of your ESOP journey, were they valuable? Any insights you have there?
Yeah, they were critical, Josh. I mean, the repurchase obligation study we were doing every 2 to 3 years, our share price was going up significantly every year. Our population was growing. We were not static, and therefore updating that study on a regular basis was critical to us having accurate information to manage the company. Now, a couple things I want to point out on the repurchase obligation study. Management really had an obligation, and in particular, the payroll and HR departments had to put together really accurate census to forward to the TPA. So they need to know, correct birth dates and expected retirement dates and all those sorts of things, so that they had all the information that they need, so that they can make accurate projections about what's going to happen with that obligation over a period of time. On the sustainability side, and we did do sustainability studies, not as often. And what we ultimately concluded was, in our situation, we recognized after doing 2 of them that unless something really changed significantly, we were in pretty good shape. But on the census, or on the sustainability side, we had to give the valuation folks and the TPA good, accurate projections, because if we just took a half-hearted effort at oh, we're just gonna our sales and income are gonna go up 3% every year for the next 5 years. Well, is that really accurate? Did you really spend any time thinking about what that's going to do? Did you stop to take time and project what are our CapEx needs going to be? Because that's something that doesn't necessarily impact your income statement, but it certainly has a huge impact on your cash flow, and which leads right back to sustainability and what we're talking about. And so, management has that obligation to be as accurate as possible. If you want, it's the old story, garbage in, garbage out. So if you want a good sustainability study, then you have to have good inputs.
Makes sense. So, as I'm thinking, kind of curious, little tidbits, and I'm looking, anybody have any questions, feel free to plop them in. Other things that might pop up for companies. John, I know some folks made changes to the 401k when they put the ESOP in place. Maybe it's time to revisit that a couple years post-close. And I know there's ways to, do your ESOP contribution to help cover your 401k match. Maybe give some perspective for folks, if some folks on the call here today maybe made changes to the 401k. What do you see down the road?
Yeah, I think that's you're touched on it pretty accurately, Josh. I think oftentimes you do see companies, when they put an ESOP in place, that they are concerned about cash flow, and they're going to redirect maybe company funding that was going to the 401k plan in the form of a match and or a profit sharing contribution, and they kind of turn that cash funding off and replace it with their funding needs that the ESOP has created, whether that's paying off the debt or making contributions to the ESOP to allow the ESOP to pay off its loan on an annual basis, whatever the means are. I mean, that's what we typically see. And that's not necessarily a forever. That is when in the early years when cash is tight because you got all this debt. But as things start to open up and the company sees maybe the realization of savings from the tax standpoint, as well as, hey, they've done well in their industry or whatever, they're generating cash more than they expected, and maybe they're paying off the debt sooner. So at some point, perhaps they will reintroduce the match into the 401k plan and be comfortable setting aside cash, taking cash out of the company and letting it go into the 401k plan. But in the interim, maybe while they are not quite to that point yet, but they've turned the match off, some companies will see a decrease in what the employees are putting into the 401k with their own money. And it's because they turned off the match. So they've lost the incentive the employees did to defer maybe as much as they were into the 401k plan. And what happens when some of your employees stop deferring or don't defer at the same level? Well, then your highly compensated folks maybe can't defer what they want to defer because there's rules around that and tests that you have to pass. So sometimes we will see companies take the contribution that you are making to the ESOP to allow the ESOP to pay off its loan, and you're going to allocate shares from the suspense account on an annual basis, but just carve out some of those shares and allocate them in the ESOP based on employee deferrals. So you might have, I'm just going to make up an example. You're releasing 100,000 shares each year, and the standard way to allocate that is based on compensation, or like I said earlier, maybe points. But maybe you say we're going to take the first 30,000 shares and allocate them based on what an employee deferred into the 401k plan. And then the remaining 70,000 shares we're going to allocate either based on our compensation formula or points formula. And that way you can tell employees, hey, if you defer into the 401k plan, you're going to get both allocations under the ESOP. If you don't defer into the 401k plan, you're only going to get one allocation. So that's one way to maybe keep the carrot out there to have the employees continue to defer. And I think that's important. It's important from a diversification standpoint for your participants, for your employees. So just know that you can do that. And then secondly, after the stock value starts to come back and the value of the shares that are being allocated in the ESOP is, I would say, significant enough, you could, if you are having testing problems on the 401k side, so your highly comp people can't defer as much as they maybe want. Maybe you used to have a safe harbor formula or contribution in the 401k, and that went away with the ESOP. So now you have to go through those tests, and refunds are made to highly compensated folks because you can't pass the tests. Well, you can actually use your ESOP contribution to satisfy the safe harbor contribution for the 401k to give you that free pass on the 401k deferral testing. So you can't do that in the very first year or two because the value that people are getting in ESOP is not high enough because the share price is too low. But as time goes on, maybe it's year 3 or 4 or 5, somewhere around there, it's probably high enough at that point where you can introduce this concept if you need to. So just know that that's an option that's there that many companies don't even realize that that's an option.
Yeah, I want to step in if I can, just from a culture standpoint, and talk about what John was just talking about. And maybe I'm playing the devil's advocate or whatever, but what I find sometimes, and we experience this as well, is if you potentially take away that 401k match or the profit sharing that goes into your 401k at the very beginning of your ESOP, from a cultural standpoint, the employees who don't really understand what it is that they're getting and the value of what they're getting through an ESOP, they look at it as, okay, they took away something from us and we got this garbage couple of shares of stock that don't really have any value in return. And it was just, they'd start looking at it as, well, that was just another ploy of management to cut cost and take something away from us. So, while I understand, obviously you got to run the business and you got to make this thing, as we talked about, sustainable. You also have to take that cultural perspective in and make sure that you're not doing something that's going to have ripple effects down the road with your employees.
Great comment. So I have a few folks ask some questions, which is fantastic. Thank you. I'll go ahead and kind of read them off. First one, might be best for John or Kirsty, but any of the three of you feel free to chime in on any of these. When you repurchase shares from a former employee, why wouldn't you just want to reallocate them? What are pros and cons maybe against reallocation? I know that can be a whole topic in and of itself. I'm sure any of the three of you want to take first stabs at that.
So I think it kind of, I'll start and then I'll let John or Jeff jump in. But in terms of why wouldn't you want to immediately reallocate them, that number can fluctuate over time. So maybe in certain years it's a very small number, other years it's a very large number. And depending on the dynamics of the plan, i.e. if, maybe perhaps the company's a partial S-owned ESOP and they receive S distributions, perhaps the people that have been there the longest have large cash balances. They may not even still be employed at the company. But that cash in the plan is used to repurchase shares. So perhaps your newer current employees might not benefit from that repurchase, but perhaps, and I'm kind of using extremes here, but I have seen this. It could be that your terminated participants that have a larger cash balances would inherit the lion's share of those shares just by virtue of them having the larger cash balance to buy back those shares. So that might be one reason. Again, it's going to depend on facts and circumstances of the plan, but that would be one kind of really highlighted reason that I would say I'm not sure you want the plan to repurchase the shares.
Well, and Kirsty, even to a from a sustainability standpoint, as we were talking about earlier, right? If you start reallocating those shares right away, you've paid off one obligation and then just created another obligation that's going to continue to
Yep.
go up in price in the future. So, you're sort of, in a sense, compounding the issue.
That's exactly right.
Yeah, and I would say too, recycling, I think, is generally the common practice in early years because the numbers are smaller.
And it's
And
easy.
and it's easy. It's the easiest of any of the options.
Yep.
But at some point, there's going to be an uncomfortableness to that, like Tristy mentioned, and Jeff as well. Your benefit level is going to go like this because your people that have terminated are impacting this. So if you have a lot of terminations in a year, you're going to see that if we recycle, we've now just increased our benefit level this year, but then next year was a light year on terminations and our benefit level went down because we didn't have as many shares to reallocate. So that's going to be hard to explain. It's going to be inconsistent. And so at some point, you might start to encounter that. So that's when you might look at these other strategies. So there's no, I think the main thing is there's no right or wrong answer, and no right answer that's always right for every situation. It's something that you just need to know there are options, and you need to do some analytics to find out what's best for your company at that point in time. And that's a critical comment as well, in that what you do this year might not be what you do next year, and that's okay.
Yeah, and I know we want to
And
get to these other questions, but I want to just drop a sentence on you real quickly. I've had very mature plans, and I assume there are some of you that have mature plans that are on this call, where they would try to manage to a 10 or 12% benefit level. And because there was a have or have not situation, and it was only going to get worse over time by recycling, they actually had to increase their benefit level. So managing to a certain benefit level is great, but in some situations, we actually had to raise their benefit level to 25% to kind of, straighten the plan out and make sure there wasn't a negative impact evaluation in the future.
Two quick points. To our earlier point that we were talking about, there's another good reason why you want to consider paying terminated employees off as quickly as possible. Get them out of the plan so that they're not impacted by bringing shares back in, and they don't get that benefit that they wouldn't otherwise be entitled to. So that's point number one. And point number two, real quickly, and I don't want to go down this rabbit hole, but for those really mature ESOPs that maybe are getting towards the end of their available shares to allocate, making decisions about how you bring in old shares can potentially help you sustain your ESOP beyond your initial allocation period.
Good comment, Jeff. Okay, a couple more. One quick one. Are there any, and maybe this can go to John, are there any financial models that are available that we can use for the repurchase obligation study? I mean, Jeff, John, what do you typically see? Does one have to engage, I imagine, or is there something out of the box that the client might be able to do some rough math themselves?
Yeah, there are. Well, as far as I know, I think there are two tools available. One Principal has, and our clients have full access to that tool on the plan sponsor website. And then the other one is Telescope. It's a software that can be purchased to run repurchase obligation studies. And aside from those two tools, you would have to engage someone, and typically that's your record keeper, your ESOP record keeper. Maybe sometimes it's an accounting firm, but I would say your first place is to talk to your record keeper.
Fantastic. Thanks, John. So two more questions, both different, but that's good. Secure Act 2.0. And implications, to the plan document. What's best practice for how to keep up with law changes now that I'm an ESOP? I mean, Jeff, what have you seen kind of works best? Do you count on the trustee and John and Kirsty to send me an email about stuff? How does the company stay abreast as to implications to the ESOP?
Yeah, well, in terms of staying abreast of things, I mean, obviously, the associations that are out there, and I'll mention them, the ESOP Association and the NCEO, staying involved in those organizations like that, number one, is a great way to keep up with things. They have all kinds of information. They're usually right on top of legislation and anything that impacts an ESOP. So that's number one. And number two is just open and regular communication with your professionals, whether that's your trustee, your TPA, your ESOP attorney, whoever it is. That you would hope that line of communication is open and that you're speaking on a regular basis about things like this.
Great comment, Jeff. So the last one I have, can open it to all of you. I certainly have thoughts on this as well. What are the most direct levers a business has to drive up share price? This client has found that strong annual results and debt paydown might not be as directly correlated as much as some other factors, i.e. interest rate hikes or 5-year forecast. I know a lot of our clients have been dealing with a rising interest rate environment over the last year or two and seen the impact on share price, and maybe, not quite move the same way that they thought it would. I have thoughts here, but Kirsty or Jeff, your thoughts on kind of what you see. Kirsty, I know you see this day in, day out.
Yeah. So generally, it's the debt pay down. It depends on facts and circumstances, but the debt pay down usually is huge. It has a huge impact on valuation, all else held equal. That debt pay down is going to produce usually a large result in value increases. You couple that with good company performance, that's going to kind of just, make that grow even more. Now, I know interest rates increasing can have a negative impact. But if you're saying you're paying down debt and you're performing well, maybe better than expected, et cetera, I would probably say you maybe need to look at the valuation and really see what those projections look like, or what the valuation advisor is considering. If you're not getting that expected result, there's got to be something within the valuation that might be hampering the price.
I would agree with Kirsty. You're right. I would, look at my valuation professional and at least question, hey, what's going on? And, if you're beating forecasts and you're getting your debt paid down, there should be some sort of a correlation there. I will say that although valuation firms won't share their secret sauce exactly, DCF typically tends to be a big part of how they figure out what your share price is going to be. And obviously both interest rates and 5-year forecasts play a significant role in that DCF model.
I agree. I think a reminder for all of our folks that, a company is valued based on, in this case, it's very heavy on the DCF, the discounted cash flow. It is the present value of the company's future cash flows. So current year performance is super critical, super helpful, especially that debt pay down. But if you had a great year, but you think the next 5 years are going to be half as good, well, that valuation firm is going to take that into consideration. So I think that 5-year forecast harnessed by the other indicators is critical. Along with, as you both said, scrubbing that valuation report. Ask questions. Make sure you understand the methodology. Why did they pick this weighted average cost of capital number that they picked, or how are they weighing these metrics together? It's good to ask those questions. You don't just have to take that report for what it is. It's okay to ask and learn and get smarter, and it may even get surprised. Fantastic. Well, we are about up at the time. Thank you so much for the Q&A questions from the group. Thank you so much to our panelists. One or two kind of housekeeping items. Just want to mention 2 things. So one, if you have future ideas on topics, we want to hear them. So email Danny, let us know. I think we had a survey that went out. Maybe we can throw a link in the chat for everybody with that survey again. But we want topics that you want to hear about. We've got the best professionals in the country. We can talk about anything. So we have ideas, but let us know. Let us know what you want to hear about. The other thing is to tee up April. We're going to have our next ESOP forum, April 23rd. More to come. We're going to be taking a deeper dive now that we've talked about early years of the ESOP and what to think about. We're going to take a deeper dive into repurchase obligation. Not only what is it, but actually strategies and tools for how companies plan for that eventual share buyback. people do a lot of different things. So it'll be good to talk about what all of those things are. Everything from pay-as-you-go to COLI products to investment strategies. There's a lot there. And so that's going to be the main bulk of the next meeting that we have, the next forum that we have in April. But let us know what other ideas you have. We've got the whole year and want to make sure we're hitting topics that are enjoyable for you all as listeners. With that, thank you, Kirsty, John, Jeff, and Danny. We appreciate it, and we'll talk to everybody soon.
Thanks, Josh.
Take care. Thank you.
Bye.